In this week's video, I'm going to be talking about shareholder loans. I'm going to be explaining what shareholder loans are. I'm going to explain what type of transactions will result in a shareholder loan. I'm going to talk about how to manage your shareholder loan balances so that you don't inadvertently trigger tax consequences. Now let's get into it. Hi, welcome to my channel. My name is Irene and I'm a CPA here in Canada. I post videos explaining important accounting and tax concepts using simple language to help business owners gain financial clarity. Make sure you hit that like and subscribe button for more. So at its simplest, a shareholder loan is when a shareholder gives a corporation money that needs to be repaid back to the shareholder at a later date, and vice versa, where the corporation gives money to the shareholder that needs to be repaid at a later date as well too. So let me illustrate an example for you. You just decided to incorporate your business, and now your business is its own legal separate entity. And let's say the corporation doesn't have any sales or any customers yet, but it does have business expenses. And so you, as a shareholder, you decide to inject, which is deposit, $10,000 of your personal fund into the corporation's bank account so that the corporation can now pay for its business expenses before it starts to generate sales. So in this scenario, the corporation would now have a $10,000 loan due to its shareholder, to which then the corporation would have to repay you back at a later date. Now, this is called a shareholder loan credit balance. So on the other hand, now, let's say your business is making a lot of money now, and you've decided to take money out of the corporation to buy personal items, such as a new car. Let's say for this new car, you needed $70,000 and you took that money out of the corporation. So now in this scenario, you would now owe the corporation $70,000 as a shareholder loan, which the corporation would expect you to repay at a later date. Just like how if you took a loan out at the bank would expect you to repay that as well too. And now in this scenario, this is called a shareholder debit balance. Shareholder debit balances can be cleared through dividends and salaries. I will explain that later on in this video. So the balance of your shareholder loan account refers to the running total of shareholder loan transactions at any given time. It's basically the cumulative balance. So let's say, for example, you've only ever had these two transactions where you've injected $10,000 of your personal funds into the business to start it up, and then you later withdrew $70,000 out of the corporation to buy your personal items like the car. So now the shareholder running balance, the total balance, is going to be $60,000, which you owe to the corporation because it's 70 minus 10. So basically how it works is whenever you take money out of the corporation for your personal funds and your personal lifestyle, then the amount you owe to the company will increase, right? And then whenever you put your own personal money into the corporation or you purchase business expenses on your personal card by accident, then that will become a shareholder loan in which the company would then owe you money as a shareholder. So technically speaking, if you had a shareholder loan balance in which you owed money to the corporation, you technically would have to repay that amount back to the corporation. However, normally what happens is that the corporation will now recharacterize all of the withdrawals that you've made as a shareholder throughout the year. And the corporation is going to recharacterize those withdrawals as either a dividend, salary, and or a bonus issued out to you as the shareholder. This way, it's going to clear out that shareholder balance. So when the corporation recharacterizes your withdrawals as either a dividend, salary, or bonus, then you as a shareholder will report those amounts, those withdrawals, on your personal tax return as either a dividend, salary, or bonus, which then you would be taxed at personally in your hands on your personal tax return. Salaries and bonuses are a tax deductible expense for the corporation. Dividends issued out to shareholders are not a tax deductible expense. If you are unsure of how you should pay yourself as a shareholder, either through salaries and or dividends, then you should watch my video here where I break down these two different methods and compares the pros and the cons. Now we'll talk about the accounting and bookkeeping of shareholder loan accounts, okay? So generally speaking, whenever there is a transaction between the corporation and the shareholder, your shareholder loan account balance will change. And all of the ongoing transactions between the corporation and the shareholder is going to be recorded within the bookkeeping. So it's really important to understand how this works, okay? So let me give you an example. Let's say you went to Staples and you bought a new printer, a new computer, new office supplies for the corporation. However, you left the corporate credit card at home. And so instead, you take your personal credit card and you purchase those business items on your personal credit card. So for this transaction, how it would be recorded as is the amounts paid for the office supplies, the printer, etc. Those would be an expense to the corporation. And then the other side of that transaction would be a credit against the shareholder loan account, which means that this would increase how much the corporation would owe to you as a shareholder. Now, on the flip side, let's say you decide to go out and buy some new clothes, new shoes, new personal items, etc., and you use the corporation's credit card to pay for those personal goods. Now, in this transaction, it's going to increase the shareholder loan in which you owe to the corporation because they bought stuff for your personal needs using their corporate resources, right? The corporate credit card. So how this transaction would be recorded within the bookkeeping is that it's going to be a debit to the shareholder loan account, which would increase how much you, the shareholder, owes to the corporation. And then the other side of that transaction would be an increase in the corporation's credit card balance. So all of these transactions between the shareholder and the corporation has to be recorded properly and accurately within the books, especially if you have a third-party bookkeeper. It's really important to communicate these transactions because at a glance, a third-party bookkeeper may not be able to determine whether something is personal or business related. So you want to always make sure that these transactions are properly categorized. So please know everything I'm talking about here is for incorporated businesses. If you are a sole proprietor, none of this will relate to you because you and your business is one entity. Doesn't matter how many sole proprietorship businesses you operate, if nothing has been incorporated, you and all your businesses are one entity. So whatever money you make from the business, you will get taxed on it right away on your personal tax return. Whatever money you take out of your business's bank accounts, it's still one entity. When you are an incorporated company, so you have a corporation, you and the corporation are two separate legal entities. So whenever you're operating a business, whether you are a sole proprietor or you have an incorporated company, it's always recommended that you need to keep your personal expenditures and your business expenditures and whatnot separated, okay? Because it makes the bookkeeping even more difficult if everything is being commingled together. Commingling meaning you're mixing all your personal transactions and your business transactions into like one bank account, one shared account. That is a big no-no, especially if you are incorporated. When you are commingling your funds, you are at risk to pierce the corporate veil, which then means that you are removing that legal distinction between you and the corporation, which removes the biggest advantages of incorporating the business. And then all your personal assets will then be exposed to all of the risks and liabilities. So really important to separate your personal and business funds. So to illustrate the timeline of when the shareholder debit balance has to be repaid to the company is, let's say your corporation's year end is October 31st and this year is 2024, let's say. As at current fiscal year, October 31st, 2024, you have a shareholder loan balance that you owe to the company of $100,000. So the income tax rules allow you to carry that loan that you owe to the corporation for 1 year after the current fiscal year end date, the balance sheet date. So if you repay that $100,000 back to the corporation before next fiscal year end, which is October 31st, 2025, then everything is cleared, everything is fine. But if you keep that loan outstanding and you carry that into the next fiscal year, October 31st, 2025, you still owe the company money, then that amount will get added into your personal income in the year that it was taken out, and then subject to your personal tax rate, which will typically be at the highest if you are making over a certain amount. So you might be wondering, what could possibly go wrong with shareholder loans? Well, as mentioned earlier, if a corporation loans money out or gives money out to the shareholders, the loan is expected to be repaid back to the corporation. If that loan amount is not repaid back to the corporation within 1 year of the balance sheet date, then that loan amount will get added to the shareholder's personal income in the year that the loan was taken out. This would need like a retroactive adjustment, but then basically that loan amount gets added to the shareholder's personal income, which is then subject to the shareholder's personal tax rate. So what happens with shareholder loan accounts is that it often is very hard for business owners to keep track of this account properly and accurately. And without being able to track all of this information accurately, it's hard for the business owners to track how much funds they've personally withdrawn from the corporation for their personal use. And then this will result in a unplanned large shareholder loan balance, debit balance, which is an amount the shareholder owes to the corporation. So the key here is to have a super good bookkeeping system in place so that you can always review and have a good pulse over how much of your personal withdrawals have been taken out during the year. So you're able to better estimate and forecast your personal taxes and have tax planning opportunities as well too. By having your bookkeeping done and accurately updated, this can actually save you thousands of dollars in taxes by knowing how much shareholder withdrawals you've taken out during the year, etc. tax planning. So the pro tip here is if you're expecting to have a significant personal expenditure coming up, let's say you wanted to buy a personal home or you wanted to do construction on your personal home, you are expecting to spend a lot of money over the next few years or in the next year or so to carry out these personal goals of yours, right? When you are in these types of situations, it is so important for you to notify your CPA before you do these transactions. Because with your CPA, you're able to properly tax plan and implement some sort of income smoothing plan for you. I can't get into the details of tax planning today because it's not in the scope of today's video, but it is really, really important. Again, it'll make a world of a difference. Thank you so much for making your way until the end of the video. I hope today's video was helpful, covering everything about shareholder loans. Make sure you hit that like and subscribe button for more. Over here, YouTube thinks that you're really going to like this video, so I'll meet you there.